How to adapt algorithmic strategies to market changes.
Algorithmic trading is a powerful way to automate and optimize your trading decisions, but it also comes with challenges and risks.
Markets are dynamic and unpredictable, and your algorithms need to be able to cope with changing conditions and scenarios.
In this video, I will discuss 3 key points to help you adapt your algorithmic strategies to market changes and achieve better results. Stay agile. Build algorithms with the flexibility to adjust to shifting market conditions. One of the main advantages of algorithmic trading is that you can program your algorithms to follow specific rules and parameters based on your trading objectives and risk appetite. However, these rules and parameters may not always be optimal or relevant in different market situations. For example, if the market becomes more volatile, your algorithms may need to reduce their exposure or widen their stop losses to avoid excessive losses. Or, if the market trends strongly in one direction, your algorithms may need to increase their position size or use trailing stops to capture more profits. Therefore, it is important to build algorithms with the flexibility to adjust to shifting market conditions. This means that you should design your algorithms with various inputs and outputs that can be modified or switched on and off depending on the market state. For example, you can use indicators, signals, or triggers that can detect changes in volatility, trend, momentum, liquidity, or sentiment, and then use them to adjust your algorithm's behavior accordingly. You can also use different modes or strategies that can be activated or deactivated based on certain criteria or thresholds. For example, you can have a scalping mode for high-frequency trading in a ranging market, and a trend-following mode for low-frequency trading in a trending market. By building algorithms with the flexibility to adjust to shifting market conditions, you can improve your algorithm's performance and robustness, as well as reduce your risk and drawdowns.
Monitor performance. Regularly analyze and tweak your strategies in response to evolving markets.
Another key point to adapt your algorithmic strategies to market changes is to monitor their performance regularly and critically.
Even if you have built flexible and adaptable algorithms, they may still underperform or fail in some situations. Markets are complex and nonlinear systems that are influenced by many factors and events, some of which may be unforeseen or unpredictable.
Therefore, it is essential to keep track of how your algorithms are performing in different market scenarios and periods, and compare them with your expectations and benchmarks. By monitoring your algorithm's performance regularly and critically, you can identify its strengths and weaknesses, as well as any potential problems or errors. You can then use this information to tweak or optimize your strategies in response to evolving markets. For example, you can fine-tune your algorithm's parameters or settings, such as entry and exit points, risk-reward ratios, position sizes, or time frames. You can also modify or add new rules or conditions to your algorithm's logic or decision-making process, such as filters, confirmations, exceptions, or contingencies. You can also test or experiment with different combinations or variations of your strategies to find the best fit for the current market environment. By monitoring your algorithm's performance regularly and critically, you can enhance your algorithm's efficiency and effectiveness, as well as increase your confidence and trust in your strategies. Historical data is your compass. Learn from past market changes to prepare for the future. The third key point to adapt your algorithmic strategies to market changes is to use historical data as your compass. Historical data is a valuable source of information and insight that can help you understand how markets behave and change over time. By analyzing historical data, you can learn from past market changes and patterns, such as trends, cycles, reversals, breakouts, crashes, or rallies. You can also discover how your algorithms performed in different historical periods and situations, such as bull or bear markets, calm or volatile markets, normal or abnormal markets. By using historical data as your compass, you can improve your algorithm's design and development process. You can use historical data to backtest or simulate your strategies before applying them in live trading. This way, you can verify your algorithm's validity and reliability, as well as evaluate its performance metrics and statistics. You can also use historical data to optimize or calibrate your strategies for different historical scenarios and conditions. This way, you can improve your algorithm's adaptability and resilience, as well as reduce its overfitting or curve fitting.
Moreover, by using historical data as your compass,
you can prepare your algorithm for future market changes and challenges.
you can use historical data to forecast or project how markets may change or evolve in the future based on past trends or patterns.
You can also use historical data to stress test or scenario test your strategies for different hypothetical situations or events that may occur in the future. This way, you can anticipate potential risks or opportunities for your algorithmic trading. Conclusion: algorithmic trading is a rewarding but demanding endeavor that requires constant adaptation and improvement.
Markets are not static or stable, but dynamic and unpredictable.
Therefore, your algorithms need to be able to cope with changing conditions and scenarios.
In this blog post, we have discussed 3 key points to help you adapt your algorithmic strategies to market changes and achieve better results. Stay agile, build algorithms with the flexibility to adjust to shifting market conditions. Monitor performance regularly, analyze and tweak your strategies in response to evolving markets. Historical data is your compass, learn from past market changes to prepare for the future.
By following these points, you can improve your algorithm's performance and robustness, as well as reduce your risk and drawdowns.
You can also enhance your algorithm's efficiency and effectiveness,
as well as increase your confidence and trust in your strategies.
You can also prepare your algorithm for future market changes and challenges,
as well as anticipate potential risks or opportunities for your algorithmic trading.
I hope you have found this video useful and informative.
If you have any questions or comments, please feel free to contact me. I would love to hear from you.